Welcome to Breaking News to Trading Moves. I am ready to look at the numbers.
And I am here to help parse the data. We have a specific headline today that touches on the automotive sector, and from there we're going to identify the market winners and the losers that are connected to it.
Let's get right into it then. The headline event we're focusing on is about Tesla.
That's right. The ticker, of course, is TSLA. The core piece of news is that Tesla has listed a brand new variant of its Model Y in the U.S. market.
Okay, a new Model Y. And as always, the price is what really matters here. We have a specific number.
We do. The price is set at $41,990.
$41,990. Okay, so that's the number everyone should keep in their head for this whole discussion. Let's just be clear, though, on where this fits in their lineup.
Right.
This is the all-wheel drive version we're talking about, so it's not the absolute rock-bottom cheapest car they sell, correct?
That's completely accurate. This particular trim sits just above the cheaper standard rear-wheel drive version.
So what's the big deal then?
Well, the positioning is really the critical piece here. What this does is it effectively lowers the entry price for all-wheel drive capability. And that is, a major selling point for a huge portion of the North American market, especially in places with actual winters.
Right, so you're making a premium feature more accessible.
Precisely.
And our notes here describe this move as being part of a specific strategy. They're calling it the 2026 playbook.
Yes, the 2026 playbook. This is a specific strategy that's been defined in the text, and it's built around the idea of lowering entry-level pricing now.
Without having to wait for a completely new, a new mass market model to be designed and released.
That's the key. For a very long time, you heard all this chatter about a potential Model 2 or some next-generation, truly affordable car from them.
Yeah, the $25,000 Tesla that was always just over the horizon.
Exactly. But this playbook, it takes a totally different approach. Instead of pinning all the hopes on a future platform that might be years away from production.
If it ever comes.
Right. The strategy is to utilize the asset you already have, in this case, the extremely popular Model Y, and just adjust the pricing and the configuration to hit those lower market segments today.
It's a classic case of using what you have instead of waiting for what you don't.
Yeah.
But we also have to look at the external environment. Why does this price, $41,990, matter so much right at this particular moment?
Well, the timing is directly linked to the tax environment here in the U.S.
The tax credit.
The U.S. EV tax credit is no longer available. That incentive, it officially ended in late September.
And that is a crucial factor. I mean, for the last few years, buyers, analysts, everyone was conditioned to just mentally subtract $7,500 from whatever the sticker price was.
Precisely. That was the real price for a lot of people. And now that math, it just doesn't apply anymore.
So the sticker price is the sticker price again.
It is. The implication of that tax credit expiring is that the actual number on the window has become a much more critical factor for buyers. There's no federal subsidy there to mask the real cost anymore.
So when Tesla sets a price of $41,990, they're not doing it in a vacuum. They're doing it in a market where the consumer is suddenly very price sensitive and is, for the most part, paying that full amount out of pocket.
That's the setup. A high-volume vehicle, probably the highest volume EV out there, seeing a downward price adjustment right in the middle of a post-subsidy world.
Okay, so that's the event. Let's move into the analysis then of the market dynamics. The first concept to discuss here is something called a category pricing reset.
Yes, a category pricing reset.
Can you explain what that concept means?
Sure. When you have a vehicle that just completely dominates sales volume in its category, the way the Model Y does, and you introduce a new lower price point for it, you effectively reset the baseline for the entire category.
You're anchoring the consumer's expectation of what a car like that should cost.
You are. It immediately forces every single competitor to look hard at their own pricing structures. It becomes a reference point.
So if the volume leader is now priced at, let's say, $42,000 for all-wheel drive.
Right. A competitor is going to have a very difficult time justifying charging, say, $10,000 or $15,000 more for a product that's, on paper, pretty comparable. The value proposition gets harder to sell.
Which means the potential response from these rivals is, well, it's fairly predictable, isn't it?
It forces their hand. They have to at least consider offering discounts or incentives of their own. They have to react somehow to maintain their position in the market. They can't just ignore it.
But this brings us to the second dynamic you wanted to talk about. It's described here as a kind of tug-of-war.
This is the central tension in the entire auto business, really. It's this constant tug of war between demand and margin.
Okay, walk us through the two sides of that rope.
Factor A is pretty straightforward. Lower prices can help your unit volume. Basic economics, right?
Oh.
If you make the car more affordable, you should, in theory, sell more of them.
That's the demand side. But then you have factor B.
And factor B is that those lower prices put direct pressure on your gross margin. For every single car you sell, you're just bringing in less revenue.
So how does a company, any company, resolve that tension? How do you lower the price to goose sales without, completely destroying your profitability in the process?
The analysis points to a couple of specific offsets, things that can counteract that margin pressure.
Okay.
Your margins can only hold steady if, one, your costs fall, meaning the company gets more efficient at manufacturing, supply chain, everything, or two, if your higher margin revenue streams, like software and services, grow at a faster rate than the price is falling.
So if they sell the hardware, the car itself, for less, they need to sell a lot more software to make up that difference.
That's the logic. If you can increase the attach rate for things like their full self-driving capabilities or connectivity subscriptions or other services, that recurring revenue can offset the one-time reduction in the vehicle's selling price.
It's a tricky balancing act.
Very.
There's one more dynamic to touch on before we get to the specific companies, and that's the used EV knock-on effect.
Yes, we'll get into this in more detail in the losers section, but the basic concept is that new car price cuts have a direct effect on the used market.
It's a direct relationship.
A very direct relationship. If the brand new car is suddenly cheaper, the one-year-old version of that exact same car must also become cheaper to remain an attractive option for a buyer.
It has to. Otherwise, why would you buy used?
Exactly. It pulls the whole value chain down with it.
Okay, so we've established the event and the broad market mechanics. Now, let's look at the specific companies that could stand to benefit from this. The winners.
Yeah.
And the first group, they don't actually make cars.
No, they don't. The first group of winners we're looking at is in infrastructure and the grid.
This makes a lot of logical sense. If this pricing strategy works, and Tesla, or any EV maker for that matter, puts more electric cars on the road, the demand for electricity and the means to deliver it goes up.
That's the entire thesis. If lower pricing lifts overall EV adoption, there is a subsequent, almost guaranteed demand for more infrastructure. It's a pure volume argument. More cars equals more load on the system. Simple as that.
And we're not just talking about, abstract demand for power. We're talking about specific physical hardware here.
We are. We're talking about the charging hardware itself, sure, but also all the behind-the-scenes stuff, the electrical distribution gear, the grid upgrade work, all the things you don't see.
What are some of the specific areas of work that are mentioned?
The analysis highlights three main areas: commercial sites, so office parks, shopping malls. Then you have fleets, which is a huge and growing area. And finally, residential upgrades. All of these locations require physical equipment to manage the flow of electricity safely and efficiently.
Okay, so who are the companies that are positioned to benefit from this kind of broad build-out?
There are three tickers to keep an eye on here. The first one is Eaton. The ticker is ETN.
ETN.
ETN. Eaton is a major player in power management. They manufacture the heavy-duty stuff. Switchgear, transformers, circuit protection components, all the things that are essential for grid stability and for distributing power.
They make the guts of the grid, basically.
That's a good way to put it. The second name on the list is Quanta Services. Their ticker is PWR.
PWR, for power.
Right. Quanta operates more on the services side of things. They are heavily involved in the actual grid upgrade work, so the physical installation and the ongoing maintenance of all this infrastructure.
So when a utility needs to harden its grid or expand capacity, Quanta is one of the companies they call to do the work.
They are very often the executor of those big, complex projects. And the third company...
Go ahead.
Hubbell. The ticker is HUBB.
HUBB.
Hubbell is somewhat similar to Eaton. They provide the electrical and electronic products for construction and industrial applications. This includes things like the connectors, the enclosures, the utility solutions that are required whenever you're building out new charging networks, or even just upgrading a home's electrical service to handle an EV charger.
So the idea here is that these three companies benefit no matter which car brand is being plugged in. It's a pure infrastructure play on the growth of EVs in general.
Correct. Their success isn't tied to one OEM's market share. The next group of winners follows a very similar volume-based logic. We're looking at the public EV charging networks.
Right, the gas stations of the future. The thesis here is also about volume, I assume.
It is. The argument is very simple. More EVs on the road will, over time, lead to a higher number of charging sessions on public networks.
We need to be a little more specific about who is doing all this charging. The analysis identifies a few key driver profiles.
It does. First, and this is a big one, it points to drivers who don't have consistent home charging. As the price point for a car like the Model Y drops to $41,990, the buyer demographic starts to expand.
It goes beyond just homeowners with two-car garages.
Exactly. It starts to include people who live in apartments or condos or dense urban environments where they have to rely on public charging infrastructure.
And there are other types of users mentioned as well.
Yes, rideshare usage and fleet use. These represent high-frequency, high-mileage users. If a fleet operator, say for a delivery service or a corporate car service, buys a bunch of these lower-priced Model Ys,
Those vehicles are going to be on the road constantly.
all day long, and they're going to require frequent fast charging to stay in operation and make money. They can't afford downtime.
So which companies are we looking at in this space? The charging networks themselves.
Right, the charging network stocks. The first is EVgo. The ticker is EVGO.
EVGO.
The second is ChargePoint. Its ticker is CHPT.
CHPT.
And the third one is Blink Charging. A ticker for that is BLNK.
BLNK.
For all three of these companies, the logic is consistent. Increased vehicle density on the roads leads directly to higher utilization rates at their charging stations, and that utilization rate is the primary driver of their revenue models. More cars plugging in means more money coming in.
It's all about traffic.
Okay.
So let's move on to the third group of potential winners. We're going inside the vehicle now. This is about power semis and vehicle electronics.
This thesis shifts the focus from usage to production. It focuses on the build volumes. Simply put, higher EV build volumes increase the demand for all the components that go inside them.
And what kind of components are we talking about here specifically? It's more than just a battery and a motor.
Oh, much more. We're looking at things like power management, semiconductors, inverters, all kinds of sensors, and just the general electronic content per vehicle, which is already much higher in an EV than in a traditional car.
And an inverter, just to be clear, that's the component that converts the battery's DC power to the AC power that the motor actually uses, right?
That is correct. And that component, the inverter, requires some very sophisticated and powerful semiconductors to work efficiently.
Now here's a question. Is there a risk here? If Tesla is aggressively cutting prices on their cars, won't they just turn around and put immense pressure on these suppliers to cut their prices too?
That's a very fair point, and the analysis does note that caveat. This demand exists even if the OEMs, the original equipment manufacturers like Tesla, continue to push their suppliers hard on costs. That's a given in the auto industry.
So how does that work out for the suppliers?
Well, the expectation is that the sheer increase in total volume will more than compensate for any per unit pricing pressure. Selling 10 million chips at a slightly lower margin is still better than selling 5 million chips at a higher one.
Volume makes up for the squeeze. So who are the tickers in this space?
We have two to highlight. First is ON Semiconductor. The ticker is just ON.
Oh.
They are a key supplier for what's called intelligent power and sensing technologies. A lot of the brains behind the power management systems.
And the second one?
Analog Devices. The ticker for them is ADI.
ADI.
Analog Devices is heavily involved in battery management systems, or BMS. These are absolutely critical systems for monitoring and managing the performance, the health, and the safety of the main battery pack.
Okay, so that covers the winners. We have infrastructure, charging networks, and component suppliers. Now we have to look at the other side of this, the losers. The first group mentioned here is EV startups.
Yes. The thesis here revolves around something called the value per pound challenge.
Value per pound. Explain that concept for us.
It's a way of thinking about the competitive pressure that gets created when a product with very high brand recognition, like the Model Y, is suddenly offered at a lower price point. It just raises the bar for what every competitor has to offer.
It sets a new standard in the consumer's mind for what they expect to get for their money.
Exactly that. A consumer walks onto a lot or browses online, and they see a Tesla Model Y with all-wheel drive for $42,000. That becomes their new baseline. And for the smaller players, the startups, the financial impact of that is acute.
They don't have the scale to compete on price in the same way.
They don't. They may be forced into offering much heavier incentives just to compete with that $41,990 price tag and get people to consider their vehicle instead.
And what happens when a startup that's already burning cash starts offering heavy incentives?
Well, it leads directly to strained cash burn and even thinner margins. Most of these companies are still in a phase where their number one goal is just to preserve cash while they try to scale up production. Reducing prices or offering big rebates, it just accelerates the rate at which they consume their precious capital.
It's a dangerous game for them.
Yeah.
So who are the companies specifically facing this pressure?
The first one noted is Rivian Automotive. Their ticker is RIVN.
RIVN.
And the second is Lucid Group. That ticker is LCID.
LCID.
Both of these companies, while maybe not direct competitors in terms of vehicle type, operate in segments that overlap, or at least compete for the same general pool of affluent EV buyers. A lower price floor from the market leader just complicates their own pricing strategies immensely.
It makes their own products look more expensive by comparison.
Instantly.
Okay, the next group of potential losers is the big one, the legacy automakers.
Yes. The thesis here discusses the concept of the pricing ladder pulling the entire market down.
So if the middle rung of the ladder drops a few feet, everything above and below it has to shift as well.
That's the idea. The required response from rivals, from the big traditional automakers, is that they may have to match Tesla with their own rebates or with more aggressive list support to keep their metal moving.
And the financial impact is pretty similar to what the startups face, right?
It is. It's all about margin compression.
Yeah.
But there's a specific vulnerability for the legacy automakers. They're facing all of this pricing pressure while they're still in the incredibly costly phase of scaling up their own EV platforms.
So they're spending billions and billions of dollars to build new factories and battery plants at the exact same time the prices for the cars they plan to build in them are falling.
That is the difficulty. It's a perfect storm for them. They do not yet have the mature, optimized scale on their EV production that allows for the kind of cost absorption that a more established EV player might have.
They're caught in the middle. Which companies are listed here?
Ford Motor, for one, the ticker is just F.
And F.
And General Motors. The ticker there is GM.
GM. Both companies have electric crossover SUVs that compete directly with the Model Y. The Mustang Mach-E from Ford and the Blazer and Equinox EVs from GM.
They do, and this pricing move from Tesla puts those products under immediate pressure.
Now, the final group of losers, this one is interesting. It's not automakers at all. It's used car retailers and auto lenders.
That's right, and this goes right back to that relationship we talked about earlier between new and used car pricing. The thesis is that new car price cuts put immediate and direct downward pressure on used EV prices.
We talked about this briefly. The term used in the outline is depreciation risk.
Yes. Depreciation risk.
Yeah.
And also pricing whiplash, specifically regarding their inventory.
Okay, explain pricing whiplash.
Imagine you're a used car retailer. You have an entire lot full of inventory cars that you have already purchased at a certain market price.
Right, you own those cars.
You own them. And then overnight, a manufacturer's decision causes the market price for those cars to drop suddenly. The value of your entire inventory decreases immediately. You are caught on the completely wrong side of that price move. You have to sell for less than you planned, or maybe even for less than you paid.
And what about for the lenders? What's the risk there?
The financial risk for lenders is an increased loss severity on their auto loans and leases.
How does that work exactly?
Well, the car is the asset that is backing the loan. If that asset, the car, drops in value precipitously, the lender is less protected if the borrower defaults.
I see. So if a borrower stops paying, the lender has to repossess the car and sell it at auction to get their money back.
Exactly. And they will recoup far less money from that sale if the car's general market value has plummeted in the meantime. The gap between what's owed and what the car is worth gets wider.
So who are the tickers we should be looking at in these categories?
For the retailers, the analysis points to CarMax. The ticker is KMX.
KMX.
And also Carvana. Its ticker is CVNA.
CVNA.
And on the lending side, the company mentioned is Ally Financial. The ticker for Ally is ALLY.
ALLY.
Ally has a very substantial auto loan book, so their financial performance is quite sensitive to fluctuations in used car values and the recovery rates they get on repossessed vehicles.
Okay, so we've covered the setup, the winners and the losers. Now let's look ahead. What should we and what should you be watching for next?
There are 4 specific areas to monitor to see how this plays out.
What's the first one?
The first indicator to watch for is any follow-on price adjustments. We need to look for changes across the rest of Tesla's own lineup. Is this a one-off move for one specific trim, or is it the start of a broader pricing adjustment on their sedans or even their higher-end models?
And the second thing to watch.
Competitor responses. This is the most immediate signal of how much pressure the market is actually feeling. We're watching for any incentive announcements from rivals, whether that's cash on the hood, special lease deals, or low APR financing.
The third item?
The financials. You have to watch the numbers. Specifically, monitoring the gross margin commentary that comes out in the next quarterly reports, not just from Tesla, but from all the automakers. And also watch the mix shift toward lower-priced trims.
So you mean, are they selling a lot more of the cheaper cars, and is that diluting their overall profitability?
Exactly. Are they making up for lower margins with higher volume? That's the key question.
And the fourth and final thing.
Consumer behavior. At the end of the day, this is what matters most. We need to track the delivery trends and the leasing dynamics. The big question is, how do buyers recalculate affordability now that the federal credit is gone?
Does this lower price point successfully stimulate new demand? Or does it maybe cause some buyers to pause and wait for even further cuts down the road?
That's the data we'll all be waiting to see over the next few quarters.
It is. It's really about whether this move pulls demand forward or just resets expectations for the future.
A very important distinction.
That wraps up our analysis of the new Tesla Model Y pricing and the associated market movements.
Yes, a very specific data point with some clear connections to a number of different sectors.
Before we close out, we do have to give our standard disclaimer.
We do. Please remember, this is not financial advice, and these are not buy or sell recommendations for any security.
This analysis is purely the opinion of the author. You should always do your own research and consult with a professional.
Thank you.
Thanks for listening to Breaking News to Trading Moves.